So good afternoon, ladies and gentlemen. As you probably know, my name is Jonathan Wu. I'm the Associate Director and Head of Distribution and Operations for Premium China. Now, this year we decided to coin our talk called A Balanced Asia is a Good Asia for a simple reason. We haven't gone for some really outlandish type of topic because Asia is balancing out. The range of reforms that we've seen in the last 2 to 3 years is now starting to come to fruition. Alan Wang, who's our investment director from Value Partners, is going to spend a lot of time in depth about our China strategy and what we've done in the last 15 months and what's worked and what we are going to do in the next 12 months. And it's really exciting because we've come from Perth and then Adelaide and now Melbourne. We've had about 4 days worth of meetings. And I can tell you it's the first time that I've had meetings with clients, and a lot of you are loyal followers of Premium China, and I thank you for that. The meetings are exciting. Because the first time in 4 years, I have an awesome news story to tell everyone. There's so much reform going on in China at the moment, and now they're all pushing aside all the corruption things that have occurred in the last 18 months and clean out and whitewash that, and now they are really getting on to economic development. The reforms and the policies they came out with in a large form in March 2013. So which is why I'm excited. What's been very interesting news in the last couple of days has actually been looking at the ETF market. So we're looking at tactical asset allocations now. Because in this current environment, we're struggling to find even what Australian equities is going to look like in the next 2 years. And I haven't met an advisor in the last 4 days that has said that Australian equities is going to do exactly as well as it has done in the last 2 years. If we look at some figures, since July the 1st till last Saturday when Alan arrived in Australia, there's been $1 billion US net inflow into Chinese A-share ETFs. 1 billion. Since last Saturday to last night, there has been $1.2 billion on top of the 1 billion I mentioned into Chinese A-share ETFs. And at the same time, 2 nights ago, the largest ETF, SPY-US, based in the States, had a net outflow of $8 billion. So when you're talking about tactical asset allocation, even the US is starting to get somewhat questionable. So, as usual, any good disclaimer, all general advice, nothing specific to circumstances. Now, I want to share a concept with you called mindfulness. Now, hands up of those of you that have heard of mindfulness. 1, 2, okay, about 2 or 3 in the room. Now, I'm not selling a religion here, ladies and gentlemen, I'm selling a mindset. And the mindset is as follows. Google came up with an awesome quote about a month ago. And those of you that have been to the AFA roadshows would have seen this. And because in the information age that we sit in here today, the amount of information we could obtain from the internet is the equivalent of putting your mouth in front of a fire hydrant and turning it on. It's absolutely too much. And so we get all these preconceptions about things that we don't know very well, and China is definitely one of those. In your packs, I've written an article that was published in Money Management a fortnight ago that talks about how to be mindful in the way that we look at different investment opportunities. And there are 4 elements that make up mindfulness. The first one is observing. Simply that. Now, those of you that have been on our China study tours before would have had this opportunity to observe and to describe what you're observing. As simple as that. Because at the end of the day, when we look at news reports that come out about China and Australia, the issue is that we're not observing anything. We're just taking a very small snapshot of what China is, and that is exactly what your clients have been doing. And that's the feedback that we get from you, from your clients. The second point is participating fully. Again, this is also about immersing yourself into an experience. We all immerse ourselves into Australian equities every day, but we need to immerse ourselves into other investment opportunities. Now, those 2 things are actually less important than the bottom 2 things I'm going to talk about. The bottom 2 is far more important. Everyone judges China. Everyone judges China to be a very big country, but it's all structurally very, very hard to deal with. And there's lots of struggles, and that's why my clients won't invest in China. It's about being non-judgmental about things. And finally, it's focusing on one thing at a time. Now, in my article, I talk about how China gets described by the media as a ridiculously bad three-course meal. You start off and you get your entree, and the entree says China's got an overinflated property market, it's getting out of control, and it's going to blow up. But people have been saying that for 5 years. Then a main course gets served up and it says China's building too much infrastructure projects, leading to nowhere, that will never make money, and that's the be-all and end-all. Now, who's been to China? Okay, quite a number of you. Did anyone enjoy the traffic in China? All right, so with those infrastructure projects, everyone is so sure that there is so much traffic jam in China that the need for infrastructure is only ever going to increase. And then dessert comes and says that local government debt is out of control, it's going to explode, and China's going to hit a hard landing. Now, those soothsayers have talked about the hard landing for the last 5 years. You remember how your mum and dad taught you that if you wish for something hard enough, it's going to happen? Well, everyone's wishing for China to have that hard landing, but it still hasn't happened yet. It's just something to think about and focusing on one thing at a time as opposed to all this negative news succumbing to your view on China. So my talk today, for the first 30 minutes or so, is I'm going to give you an update on VP, our investment managers, value partners, our fund offerings. For those of you that use the Asia Fund, I'm going to give you a very in-depth breakdown of what the Asia Fund looks like, portfolio positioning, and themes that we're buying into. Then I'm going to educate you for about 15 minutes on 3 things. One is a range of resources we want you to give to your clients, and we want you to strip out our logos and put your logos on it, because we want to make you look awesome. Stock types in China is something that I think we should go back and have a chat about, because a lot of advisors that I met almost 10 years ago now, they still don't quite understand it. And why I want to go back to it is because what Alan has to say after me has got a very, very specific strategy on how we're actually arbitraging stocks to generate returns for your clients. If you notice, for those of you that have exposure to premium China, just until July, the fund returned about 8%. And finally, I'm going to give you some Australian and Chinese company examples just to give you a bit of context and wrap it in a nice bow for you before I hand it over to Alan. So ladies and gentlemen, we started 10 years ago, and this term was coined. Everyone remember the day? It was about 2004, 2005, when brick was invented. Now today, there's a lot more talk about BRICS, which is now including South Africa. But what's left now? Brazil. I don't think the Argentinian default is doing them much good. And guess what? They have an incredibly unsustainable social security system. At the age of 54, you can retire and get an age pension that's worth 70% of your average income. Now, for those of you that are 54 and above, sitting there going, wow, Australia I wish they did that. But it's unsustainable. And there's a massive portion of the Brazilian economy that is cash. Again, not sustainable. Then we look at Russia, and what do we define Russia as today? We always talk about China being politically unstable, so how do we describe Russia? Politically aggressive is the term that I've heard mostly, and that's probably a nice way to put it. But economically, their GDP is highly correlated to the oil price. And in terms of the ability to do business there and also have an environment where you can get transparent information, they are now ranked by the World Economic and Competitive Index at number 133 out of 144 countries in terms of its competitiveness in the world stage. So then we have India, and India's had an absolutely great time in the first 6 months. For those of you that have Indian exposures, everyone's seen the stock market absolutely skyrocket. But they have got 3 issues: hamstrung democracy, infrastructure is dismal, and inflation is rife. So we're left with China. And there's a lot of economists that are talking about this now and saying, when you look at BRIC, China is the only one that is left standing that is sustainable. And that's what we want to focus on today. There are 2 key questions. And a wise gentleman once told me, A lot of good things in this world have already been said, so why don't you just exactly say it the way they said it? And Kurt Nielsen said this a couple of weeks ago at his investor briefing. There are two key questions you need to define for yourself when you look at China. And they're two very contrasting questions, but unfortunately, unless I put it in this format, we tend to have our brains link these two questions when we make a decision when we look at something like China. Firstly, are we disagreeing that there are issues in China and that they will continually face them for the medium to long term? We never have. We never have. China has got lots of problems that they need to deal with. Are we disagreeing with the investment opportunity of buying stocks at a very attractive price in China? We are. That's how I want to preface the presentation today, because I want you to split these two issues as they are two very, very different issues when looking at China. Think about it, ladies and gentlemen, that 6.5 years ago, a mere 6.5 years ago, the Shanghai stock market was at 5,500 points. And today, it's at over 2,000. Where the economy was half the size as it is today. Again, a direct quote from Kurt Nielsen. And you cannot tell me that the economy is in a worse position today than it was 6.5 years ago for share prices to be this depressed. We show this chart up every year. Excuse the chart, but I didn't deliberately remove the US. It just looks like I completely wiped out the US share market. But Greater China is now worth 12% of the world's equity market today. Think about your portfolios for a second. Think about your Australian equities portion for a second. Large caps, small caps, mid caps, micro caps, long short, market neutral, absolute return, contrarian. There's 8 different types of Australian share funds. We're 2% of the world. And people come and talk to me and say, Jonathan, your China fund, your flagship fund, it's nice, but it's at $200 million. Do you think it's a bit too big? How big is industrial share funds in Australia? 6, 7, 8, 9, $10 billion? Please remember that China, even if there was a micro-cap China fund that came out, it's an awesome strategy because it's such a large market. Don't take our word for it. Shane Oliver came out with these figures a couple of months ago looking at going forward for the next 5 years, what a diversified pool of assets would look like and generate in terms of return. Yes, we can keep going on about Australian equities. And yes, we can keep going on about our franking credits. But outside of that, I'm seeing advisors now saying, I'm going to buy your China fund instead of Australian equities and start tilting out. Because originally your thesis was I'm buying Australian equities because it has access to China. China now has that turning point, and Asia ex-Japan strategies are looking at 10.3 for the next 5 years. So where do you want to tilt your portfolios, given structural deficiencies in the Australian economy? I want to give you an update on Value Partners. Again, thank you for our loyal supporters. 9 years ago, we had 19 people in our investment team. Today, we have 51. And the 51 investment team is split between Beijing, Shanghai, Taipei, Hong Kong, and Singapore. $10 billion assets under management. We are deep value. In the last 2 years, value has underperformed growth as a strategy. But over the last 14 years, value has absolutely whooped growth. And now it is reverting back. We do 2,500 company visits per annum just to find the best investment opportunities for your clients. That's all we focus on. 3 R's: right business, right people, right price. What we have compared to the market is longevity. Outside of Q, who's a recent joiner for some of their contrarian equity funds, the shortest time period a senior fund manager has spent with Value Partners is 9 years. Those of you that were at our roadshow last year, you heard Michelle speak about the property and automobile markets. You have longevity. When your senior fund managers have shareholdings in their own company and the company is worth over $1 billion US listed on the Hong Kong Stock Exchange, you want to remain with a team that is stable. 21 years, we have gone through over 6 different unique crises. And after that, we have achieved 15.9% per annum net of all fees against a benchmark that is still doing negative. I literally could put that speech, that part of the speech, on a tape recorder now. 15.9% for 21 years. Would it take 25 years to convince you, or would it take 30 years to convince you that investing in China is sustainable? And for those of you that think that today, China is more or less, or actually it's more of a question, is China more or less transparent than it was 21 years ago? The investment opportunity is there. In terms of the fund offerings that we offer, we have a China fund, an Asia fund, an Asian property fund, and an Asian income fund. Our flagship is obviously the Premium China Fund. All the returns that I'm showing you here at the bottom are net of fees. People will always talk to us and say, your fees are quite high. But I'm talking about net after fees. Our best performing fund in our suite just turned 6 years old, which is the Asia Property Fund, and no one invests in it. It's done 13% per annum despite the Chinese property market collapsing. And everyone in China is going to be homeless, apparently, because they can't afford property. 13% per annum, net of all fees. This is what we're talking about. We don't have time to talk about the Asia Property Fund today, but the other 3 funds we're going to talk about. Asian Property. Since inception, ladies and gentlemen, we do not ever show you charts that's based on a particular set time frame. We only want to compare like to like since our inception. That is us. And that is everybody else. It's been a tough 12 months for the property fund, but it's got incredible value, which I'll talk about in a minute. Platform access-wise, Premium China is on every platform in Australia besides Colonial First Choice as well as ING. If you do want them on in any other platform, please have a chat to me. The only one that's not mentioned here is OneView, which we're on as well for 3 out of the 4 funds. So I want to talk about Asia. In the last 12 months, our Asian strategy has underperformed the benchmark. But we're not benchmark aware, as we know. Our target performance on this fund is 12% per annum, net of the management fee. But in every time period, 1, 3, 6, and 12, we have underperformed the benchmark. 2 simple reasons why we have done that. And we're not shying away. I'm showing you very, very transparently we underperformed. 2 reasons. 1, we have an allocation to China A shares, which due to sentiment, it got hit quite hard. And remember, these figures, ladies and gentlemen, is only till 30th of June, not 30th of July. Second reason, we have 0 allocation to Indian equities. But I'll talk about why in a minute. That is why we've underperformed. Okay. But even though we've underperformed, we still outperform everybody else. This is all the long funds available in Australia, looking at Asia, from Aberdeen to Fidelity to Platinum to Schroders to T. Rowe to Treasury, and we outperform every single one of them since inception. When we look across the region, we think about where we want to asset allocate. Korea and China are our 2 most cheapest markets. And one of the really exciting things that we know that we've got a competitive advantage against anyone that manages Asian money in Australia is that we have access to IPOs. It's all well and good that you're bottom-up deep value and you're buying stocks on the market, but we have access to block trades. Being the first locally branded Chinese equities manager in China, now the IPO market is opening, we're looking at awesome opportunities that's coming online. We can't share those with you because they're under protected NDAs, but there's a lot of opportunities where we're getting first pick of the IPOs that we like. 2 countries that we have an overweight in, Korea and Taiwan, which is what I want to talk about today. Korea, anyone been to Korea? A few? Jeff? Okay. Now, did anyone know, actually, Jeff, did you know that when you go to 7-Eleven in Korea and you buy a bowl of cup noodles, did you know that the price is set by the government? Well, everyone knows that North Korea is run by a particular type of gentleman, and everyone assumes South Korea is a highly democratic state. It is democratic, but it is highly regulated, which is why the share prices in Korea are also quite depressed. Korean GDP is at 3%, but what's really great at the moment is that their inflation is sub 2. Korea has historically had inflation issues. But now that they're sub 2%, they have more room to grow different sectors that they want to. At the moment, there are 3 areas where they're deregulating: electricity, insurance, and banks. And the first one we invested in was electricity. There's a company called KEPCO, and KEPCO is just an electricity utility. And they had always made a loss and only backed up by government subsidies. Late last year, tariffs went up 2 to 3%. All of a sudden, they turned profitable. But free cash flow was still negative. Free cash flow was still negative. What we're hoping is that over the next 12 months, by 2015, the government will raise tariffs again by 2 to 3%, which will make the company profitable with free cash flow that is possible, which is also positive. And you imagine the company all of a sudden has a PE. Deep value stock picking is exactly that. The other interesting thing about Korea is that the dividend yield is very low. It's 1.5%, incredibly low. And people say, why? Because most of Korea is controlled by something called chaebols. And chaebols are family groups that control conglomerates. Now, everyone's heard of Samsung, but do you know how many listed entities Samsung has in Korea? They do more than just mobile phones, televisions, and computers. They have 13 listed entities in Korea, all controlled by their own family members. And there's a high chance that in the morning, you go and buy your cup noodles in a 7-Eleven, then catch the public bus to where you work and your employer. All 3 of that part of the value chain is probably from one family. And those families love cashing themselves up with very low dividend payout ratios, hence the 1.5%. The government is now moving that hopefully by the end of the year, they want to actually tax excess cash in Korea to force companies to have a high dividend yield and also attract more foreign capital. The last part is preference shares. Everyone knows the difference between preference shares and ordinary shares. Preference shares, you have voting rights, you get high priority dividends. Ordinary shares, you just get your dividends. Sorry, preference shares, you don't get voting rights. Ordinary shares, you do. But preference shares trade at currently a 50% discount to their ordinary counterparts. 12 months ago, when we started accumulating in Korea, the discount was 70% because people felt that having the voting rights was very important. But now people are starting to understand that it's less and less important. A third of the 20% we have in Korea is preference shares. I want to show you 2 stock examples of where we invest in Korea. One is SK Telecom, which is Telstra. And Telstra of Korea has a $19 billion market cap with a PE of 10 times. Dividend yield is actually really high for a Korean company. Now, what's really great, I just want to take you back 5 or 6 years when you first got your smartphone. Everyone remember that day when you got your first smartphone? And remember you could all of a sudden access your emails on your mobile phone, and now it's just become very normal. You started using something called data. What's the most expensive part of your mobile phone plan? Your data. In Korea at the moment, the average person consumes 2.2 gigabytes worth of data per quarter, which is only set to rise. Now, I want you to then think about 2 to 3 years ago when you first got your 4G enabled handset. Has your data usage gone up or has it gone down? It's gone up, hasn't it? Anyone's data usage actually gone down because they went 4G? I don't think so. But again, most expensive part of your plan. SK Telecom is the first telecom company in the world to launch a 4G network, which is an advanced 4G network where the speed is double what we have the 4G in Australia. And with their penetration by 2015 looking to go from 50 to 70%, this company is going to do exceptionally well. I don't know, I can't remember off the top of my head what the PE of Telstra is, but I don't think it's 10 times. DGB Financial Group is a regional bank, a tiny regional bank with a market cap of $2 billion. One of the things that the government is currently looking to do, and on 24th of June this year, the Prime Minister and the Deputy Prime Minister wants to increase the ability to leverage property in Korea. For those of you that were in their professional lives during the Asian financial crisis in 97-98, Korea was the most patriotic country where wives were selling their gold jewelry and melting it down to save their country. So their conservativeness in terms of property and investment property is at 50%. What is it ours in Australia? It's 80%. They want to increase that, and alongside that, the loan to deposit ratios for the banks are now at 100%. In Australia, we don't have limits. In Australia, our bank's loan to deposit ratios are 140% plus, meaning for every dollar of asset we have, that a bank has, they've lent out over $1.40, mostly in US bonds. And DGB is sitting at 92%. Most of the larger banks in Korea are sitting at 95%. And which is why, in turn, loan growth in low double-digit form is an incredibly great opportunity for us, especially when the bank is only trading at 9 times earnings. Taiwan. Everyone got really excited after I talked about Taiwan because this is a global recovery story, ladies and gentlemen. China is not a global recovery story. Taiwan is. Has a population of about Australia, and its 3 major export partners are US, which obviously is recovering very well. The EU is still very laggy, and China has stabilized. So it's become an awesome environment to invest in. And so the demand outlook is very strong. Does everyone remember what Taiwan is famous for? It's electronics. And what is very interesting about the market at the moment is Samsung versus the rest of the world has everything to do with Taiwan. 80% of Samsung electronics, their componentry comes from Korea. The rest of the world sources their componentry from Taiwan. The company that we invest in to get that exposure, it is the only single stock, Taiwanese stock we have in our China fund, but Taiwan makes up 20% of our Asia fund, TSMC. TSMC is the largest market capped company in Taiwan, so just note the market cap there, and it controls 70% of the sophisticated semiconductor production in the world. Everyone should have heard of OEM, original equipment manufacturers. This is an ODM. So with an OEM, something like, say, for example, Uniqlo, the Japanese cloth manufacturer, they've designed everything and they give the manufacturer their designs and they manufacture it. With an ODM, being an original design manufacturer, they design the componentry and then manufacture it, but only for their clients. They are not manufacturing it for themselves with a TSMC brand. That is why you've never, ever heard of it. And second half of this year, our good friends at Apple has moved a majority of their semiconductor supply to TSMC. Now, why TSMC is in such a good competitive position is because, for those of you that are tech geeks like me, when you look forward to the next iPhone, which comes out in about a month's time, and what do they always talk about? It's going to last longer, it's going to generate less heat, and the processor is going to be smaller but faster, and we're going to put more RAM in it. Well, that's what TSMC does. They develop all this technology. And going forward, as more and more things, even your fridges to your TVs to your cars are going to have more semiconductors in it, TSMC, controlling 70% of the global market, is going to capitalize on that very strongly. Something that's also great about TSMC is that their gross margin is 48%. Ladies and gentlemen, if you have a product in the marketplace where your gross margin has a controllability of over 40%, you are a price maker. This is why TSMC is so great. When we look at the rest of ASEAN, if we look at India for a minute, India, great companies, very expensive. There are some public sector banks in India that we're actually quite interested in, with their tier 1 capital ratios at about 4 to 6%. That's all there is. Very inefficient. But at the moment, we're trying to work out whether or not that's a 5-year investment story for us, or is it a 10-year investment story for us? Because we don't want to get in too early and wait forever for it to come to fruition. In Indonesia, well, as we all know, the election is technically over, but the other bloke who's now challenging Widodo is saying that there's corruption, which is quite interesting. But from an economic standpoint, what we see as an opportunity in Indonesia is energy. Infrastructure for energy in Indonesia is abysmal. It's almost non-existent, making the cost of electricity very high. So we're actually looking at some gas plays there, because it's much easier to transport and move and sell. Singapore is the cheapest ASEAN market. And what's most attractive about them is actually their property market trading at 30 to 40% discount to their NAV. What we're fearful of in terms of buying, though, is do we want to buy into a general market discount? If the market already accepts that the market price of property, listed property in Singapore is 30 to 40% of its NAV, 30 to 40% discount to its NAV, then we shouldn't be buying it because the upside is simply not there. Malaysia is an interesting place. There are 3 parts of the population that make up Malaysia. You have Chinese, you've got Indian, and you've got Malay. And the Malays are the people that you never see a Malay leave Malaysia, okay? Because it's such a good place for them to live, and they get special treatment. The Chinese are the ones, and the Indians control most of the wealth that is within Malaysia. Very powerful 2 groups of people. What we're interested in there is some of the property developers, because Malaysia is going on a 5-year reform program, which is trying to boost their economic growth and activity, because they also want to upgrade their middle class. So the real estate names are very, very interesting to us. The Philippines is probably the worst market that we're viewing at the moment. It's exceptionally expensive at about 18 times earnings. We just can't find any opportunities there at the moment. And because of the amount of cross-shareholdings, like Korea, but 10 times worse, the cross-holdings of the families within the Philippine companies are so tight, we can't get any good information out of them, despite everything we try to do. And finally, Thailand, well, we're up to coup number 22, and so next week it'll be 23. And the real estate market is actually being dogged at the moment. So if you're in Thailand and you think about all the coups that has occurred, we actually expected that people would normalize and expect that going forward that we're just going to have a continual coup. But it's actually affected the sentiment, and property sales are down 30 to 40% year on year. At the same time, we're seeing a visible contraction in consumer consumption, and there are some names in the market, as it recovers, we're also very excited to buy into. But at the moment, all these 6 countries that I just described make up less than 8% of our portfolio. Less than 8%. It is China, it is Korea, and it is Taiwan. Now, I want you to all open up your packs for a sec. And inside your packs on the right-hand side, you'll find these 2 documents. I want you to take out the one on the right first. Sorry, on the left-hand side. This thing called reasonable basis, got a nice blue-looking chart here with a bit of green at the bottom. Now, we've designed a range of resources for you to use, and with all due respect to your clients, we are targeting the lowest common denominator. Really something simple to understand. What we do every quarter, and this was launched last year, but we've been keep refining till now with client feedback. We have gotten to a point where we think we're actually really comfortable with it. Every quarter, we come out with 2 themes for each fund of ours. So we're talking about the Shanghai Stock Connect program, which is something that Alan's going to spend quite a bit of time on. And we talk about how we access that for the portfolio. It's written in a really, really simple and dumbed down way. And we want to, as I said, I want you to take the Word document and then put your logo on it. Get rid of the green and put your logo on it. We don't care what you do with it. We just want you to use it with your clients, because these presentations are 70 slides long. There is no way your client's going to sit through a 70-slide presentation, let alone yourselves. So every quarter we come out with this flyer. Use it. It's available on the website. You will get a link after this presentation. This one on the right-hand side, there are a number of fund managers that do this, and it's wonderful. But you know if they're a global fund, it's going to be eBay and Google and Amazon and those sort of companies. Tell me how many of the logos on the left-hand side of this right-hand sheet you actually recognize. Would you recognize one? One? Okay. At most one, and it's probably going to be PetroChina, or at most, if you've been to our presentations before, it's Vanke. Did you know Vanke's China's largest property developer? 2/3 the size of Westfield? I don't know. It might be slightly sizable. But we don't know about these names. Again, strip out our logo, put your logo on there, give it to your clients. I want to make you all look awesome in front of your clients because you need to give them that education. We give you SOA templates as well on the left-hand side. That comes out every quarter. Instead of having to trawl through the 8 or 12-page research report to work out what's an important part, we're going to give it to you. Again, available on the website. Copy, paste. We use the same paragraphs in our advice firm. That's why we can give it to you. And we come out with special reports every now and again. This is all resources that we give you to arm you. There is no reason after looking at these resources that you wouldn't be comfortable in using us. It's actually as simple as that because we have put a lot of effort and a lot of manpower to come through with all these resources today. This is our iPad app, and it's, as well as that, the book is in your packs, the book that was mentioned before. The 4th edition came out in January this year. There is a part in the feedback form where you order in sets of 5. It's free. The largest order we ever received was an advisor in Perth. He ordered 500 books. So if you want 500, we'll ship 500. We want you to use it. It's better sitting in your offices than elsewhere. It took me 10 months to write the book, and the feedback has been great on what we do with it. Here's the Chinese equity stock types. In China, A, B, H, and red chips. A shares are those companies which are in China that can only be bought by people in China or people that have a QFII license. And in Australia, it is AMP is the only Australian institution, but we, through VP, also have our QFII license, which Alan will talk about in a minute. That's the one where we're absolutely loving at the moment. B shares is a historical capital control mechanism by the Chinese government, and what they do is that Chinese companies that wanted foreign capital would create a new share class called a B class, and there's only 120 stocks. There are 4,000 in China, there are only 120 in the B market. Now, a strategy we implemented 15 months ago, which Alan will talk about, we're looking for companies that converted from B to being H, which again, Chinese companies that list on Hong Kong instead. A and B are mainland China, H and red are listed in Hong Kong. The only difference between H and red is incorporated in the British Virgin Islands or places outside of China or Hong Kong. Those are the 4 share types, which is a great precursor to what Alan's going to talk about. I want to show you this comparison. Just take it in for a sec. It took about 30 seconds for people in our last show to work out something's not quite right. Does everyone agree that that's Commonwealth Bank's metrics? No, they're not, are they? No. But okay. But let me ask you a question. If this was Commonwealth Bank's metrics, would you buy it? Ron knows exactly where I'm going with this. Would you buy CBA at those metrics? Okay. Everyone see my point? Okay. Thank you. You'd buy Commonwealth Bank at that metric, but you wouldn't buy Bank of China at that metric. Why? Is it a preconception? It's a preconception, isn't it? We're trying to re-educate that. There's nothing wrong with Bank of China. There are big 6 banks in China, there are big 4 banks in Australia. We're trying to prove to you that these are viable models. You would buy this in a heartbeat if this was Commonwealth Bank. Here's another example. Stockland versus Poly Real Estate. Stockland, as you all know, I think everyone should know what Stockland do. They both develop and manage property. Poly only does development, but it was the closest thing we could find. Now, we're not trying to find examples that are so obvious. But when people think that Chinese property is going to collapse, I'm really concerned with how they look at the market because you look at those metrics. I'm not playing any games on this one. This is the right one. This is the right one. Okay. The property market is collapsing because the P's are sub 5, its EPS growth is 21, its dividend yield is 4%, its ROE is 20. I can't see Stockland even coming off on a bad year. It's recovered that much in terms of EPS growth. And it's 16 times. Why are we buying Stockland? It's just something to think about. So in summary, please be mindful of how we look at Asia and China. Reconsider your portfolio exposures, especially with Australian equities nowadays. Remember that we've done it for 21 years. We're not pulling a rabbit out of a hat. We've designed a range of resources for you to use. And most importantly, when you go back to your offices, we want you to only think those 4 words, very important. Think Asia, think premium. So with that, I'd like to introduce Alan Wang. Alan is our investment director, one of 2 investment directors from Value Partners. Now, those of you that have come to our roadshows before, you would have heard Alan speak. We're really excited, as I said before, because we have a really great news story. Really great news story. We've done really well in the last 15 months, and we look forward to the next 12 months. But I'll let Alan speak more about that. Ladies and gentlemen, Alan Wang.